Great. Well, good afternoon, everybody. This is Price Headley. Thrilled to be with you as we talk about what's become my favorite strategy in today's markets. 2022 has been a volatile year for a lot of folks. And we want to turn that volatility feeling of worry into actually a volatility opportunity, and how you can use very cheap $1 options and how we've made up to 300% gains here thus far this year. And the year's only halfway over. It's already been a great year for our Grand Slam options, folks. We're going to walk you through how this works. And let me just remind you as we get started here that everything that I share with you today is based on our proprietary research and is intended for illustrative purposes only. These should not be considered specific advisory recommendations here today. Just know that stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of its future results. And do see our terms of use on our BigTrends.com homepage for more information in this regard. So with that understood, let's get going here. And what I want to focus you on in this hour together, for me, I know you've got a lot of great hours of content in this fantastic package that David and Anka have set up here of presenters here. Now, I've traded for over 30 years. So it's one of those things where I've seen all kinds of things that work and a lot of things that don't work too. And so really what I focus my Big Trends subscribers on is really the best of the best. This method is one that's actually come around to me just in the last, I'd say 5 or 6 years, is really one of my go-to growth methods, using cheap options just in select windows. You can't just buy them randomly and hope to win. You have to be very specific about how you're going to find an edge. So my edge is actually not one indicator, not two, but actually 3 key things lining up together: the CCI, the Big Trends bands, and the ADX. And we talk about an option price at $1 a contract. That means that, remember, one option contract controls 100 shares. You have to multiply how an option is quoted at $1 and multiply that times 100 to say, okay, to control 100 shares, one contract will cost you $100. That's still a very cheap option contract. It's an option contract that we look to turn that 100 into 200, then 300, then even $400 on some of our position, and that's where we get up to the 300% or 4-bagger kind of grand slam opportunity. So we're going to walk you through something where I'm actually going to extend my Memorial Day offer here today as part of this special synergy event to really focus you on how you can lock in great value and capture my next couple hundred trades for an incredibly low price point. Now, who am I? I founded Big Trends back in 1999. Actually, David worked with me in the early to mid 2000s, and I was an early investor in timing research too. So bottom line is that I'm a believer in the importance of timing and the importance of quality research. I've been doing this for 32 years myself after graduating from Duke University, and kind of caught the trading bug while I was in college. And switched majors, stayed on the 4-year plan, was my dad's only requirement, and then did this for somebody else for the first most of the 90s before I realized, okay, the internet's going to be the wave of the future. I can launch BigTrends.com and share what I've learned to tens of thousands of traders now that we've served around the world. Blessed to be inducted into the Traders Hall of Fame and all kinds of other goodies there. But bottom line is, it's about research. It's about data telling you that you have an edge. This is not just waking up on which side of the bed and saying, I feel good today, I feel bad, I feel bearish or bullish today. It's a feeling has to be thrown out the window, folks. So everything I share with you is based on the data and the charts. So here's a trade just here recently that we did on Range Resources, RRC. Now, this is not a household name in the energy kind of wave that we've seen be the big leader here in 2022 to the upside. Everybody thinks everything's been bearish, but as you know, energy has been a massive outperformer. But it's about catching it in a sweet spot. So what do we show in this chart? We show a couple of the core indicators here. One is the Larry Williams percent R indicator. Percent R means percent range. Okay, so when we talk about percent R here, we're saying, okay, look, percent R means, okay, where are you within the range? As you know, the definition of a range is if you're trading between a proven set of highs and lows, you can extend that out. But you can see on this chart, it's broken out here. It's above that old range high. That's where we get a lot of trends starting off, when you get breakouts to the upside of above the resistance or below the support on the downside. The blue line is the CCI, the Commodity Channel Index. I use this on a lot of individual stocks to say, you know what, when that goes overbought, both these indicators went overbought off of this prior bar before we got in. On the next bar, it was closing above that prior bar's high. So that's where we're getting in on what I call the confirmation bar that indeed the institutions, who, let's face it, the institutions drive the market. You and I as individual investors, whether you're trading $1,000 or $1,000,000, we're small fish in the bigger pond of billions and tens of billions swishing around at these variety of these institutions and hedge funds. They want to win just like you and I want to. And the reality is they can't jump in all at once. They gradually build their positions in and out. Otherwise, they jump in all at once, splash all the water out of the baby pool, and have nothing left, right? They would have a huge gap up if they tried to buy everything at once. So the idea is that, okay, look, we're seeing this kind of gradual trend developing. And I believe that's why trends take more time and these moves last longer and often go bigger than you and I would expect to the upside and at the downside when we get trends, because the institutions are running these things up, they're running these things down. And so your job is to know when you're in one of these sweet spots. Now, notice a lot of people have the view that percent R, any indicator, that whether you use an oscillator, a trend following measure, whatever, if you measure something like percent R and say it shouldn't stay overbought this long, look at how long this thing stayed overbought. On this chart, it's for in the neighborhood. These are 30-minute bars, by the way. So I'll use fairly quick bars when I want to catch about anywhere from a 2 to 5 day trade here. Sometimes they can stretch out for a couple of weeks or even more, but most of the time these are seeing targets hit very quickly. In this case, within 24 hours, that's a little quicker than average. Most of the time, it might be 2 or 3 sessions when we catch these really clean trends. But you can see that percent R staying overbought, the blue CCI line staying overbought. Actually, on this whole chart, it doesn't even come back out of overbought over here. It's still staying above that green overbought threshold. So you don't want to trade something if it's stuck in between those green lines, in between that overbought oversold threshold. That's the chop. Don't trade the chop because you're basically missing the bigger trend. That's the name of my site, bigtrends.com, because when this goes overbought, sure, once we get in, we deal with a little pause, a little bit of let's catch our breath for a couple of 30-minute bars or about an hour's time. But then it's launching again into the afternoon. And then, of course, the second day, this is the following trading day. We're in on May 25th or out on May 26th. The second day is where we got all 3 of our targets right here on this massive blast higher where the stock, look at where the stock started off. It started off about $31. Now stay with me about option strike price selection. What kind of option do I buy here? First of all, I've got to buy an option that I usually go out to the next month or roughly about a month's out till expiration. In this case, it was the June 17th monthly options. So they're not quite a month out, but they're close enough. And I'm going to talk about my stop rules here in just a little bit too. So that's important as well. But you can see I paid 85 cents, or to control 100 shares, it's $85 to control 100 shares of stock when the stock's trading around 31 bucks a share. As you know, 100 shares on 31 would be a $3,100 investment. We're controlling it for less than $100. So you see your leverage here is more than 33 to 1. So the idea is that, okay, look, the stock goes from 31, it eventually goes to 36 the next day. That's a huge move, obviously, if you were a stock trader, you'd be thrilled going from 31 to 36, making 15% plus on your money. We were happier to make 100, 200, and then 300% on our money. So the idea being that, look, when we get a double, first thing is that next morning as it popped up in that first half hour to hour, we're taking that first target up here about 33.5, getting a double when it's moved up about maybe 5 or 6%. And when we get a double, we sell half the position of the double. So the beauty of this is that you say, okay, look, if I can get my risk capital back by selling half out at 100% gain, now I've got a quote free trade, an opportunity to really, some people call it the market's money. I don't. It's still your money on the remaining half, but you have taken your risk capital and put it back in your pocket. That gives you the emotional as well as financial freedom to stay with the trade. Those next couple points up from 34 to 36 is where we cashed out at 200% on half of our remainder, 300% on our final piece of the trade. As we know, not every trade is going to hit 300% targets. But here's another exceptional example where I traded one of the cruise line stocks, Norwegian Cruise Line. NCLH is a symbol. We maxed out at a 204% gain on our second target. And what do we do with the rest of that trade? So this was an interesting one because this was, we recommended a April option that was recommended on March 28th. So we only had roughly about 3.5 weeks ago before expiration. We've got now on the, this is an hourly chart example. So we look at a lot of time frames here, but hourly, 30-minute, daily are kind of our main time frames that we'll look at. We're starting to see these things, especially the CCI really getting going over that plus 100 line. We're saying, look, everything's signaling to us that this is ready to roll. And so NCLH, when the stock's trading about 19, we bought the 21 strike calls. So we were buying out of the money options. A lot of people would say never trade out of the money options because you could lose what you put into it. That is a risk factor. You could lose what you put into it. But one of our rules is that if we're wrong after 5 trading days, we just cash it out, whether it's a win, lose, or draw. If it's not working, typically it'll be a little bit of a loser. Could be a medium-sized loser, but we know that the leverage can work for us. So we want to control our risk. So the 5-day time stop is an important idea. We're going to get more into that. But look, 74 cents, $74 a contract, controlling 100 shares and you can see here that, of course, if you're putting in, say, $1,000 a trade, then you figure out, okay, well, then I can put in this case, somewhere in the neighborhood of about 13 contracts and not cap out at 1,000, and 14 would push you over. But the idea is that, look, from this perspective, you're saying, okay, if I get my first target here where the stock runs up to about the strike price, and that's a big misconception. People think, oh, well, if I paid 74, it means I need like $1.50. That means it's got to go $1.50 over to 21 strike, right? To 22.5 to get my double. Wrong. The idea is that if you get speed of movement, this thing stays overbought. You can see how beautiful that CCI indicator is. It's staying overbought in that first leg. We kind of get what I call a retest in here, where it kind of hangs around and holds, and then it pops up to our next target at 204%. That subsequent morning on this gap up, popped up to about 23 at that high there. Okay, so it's moved from 19 to 23. Stock's up just over 20%. We're getting 204%. So you can see about 10 times leverage in this example because we lost a few days of time. And then it starts coming back down and we don't quite hit our 300% target. It got close, but as it came back down, we said our trailing stop ticked our last piece of the position out at a 98% gain. All this happening in 6 trading days, just over a calendar week. So the beauty of this is that you say, okay, look, we've got a window of time to take advantage of this. We know that we can make money up or down. So we talked about some bullish call trade examples. What about bearish put trade examples? When you buy a put, you're buying a right to sell the stock. That gets more valuable as the stock drops when you're a purchaser of that put option. So next slide, how do we make money on this? So here's a bearish example on Zillow, ticker symbol Z. Of course, a big online home listings site. Zillow is one where we were getting bearish signals on the downside. In this case, on percent R, CCI, we're going to go into a third leg of the stool, the ADX, here in a little bit. You can see these were all signaling when the stock's breaking down here in the neighborhood of about $45 a share. Now, look what we had to buy. As you know, volatility's been up in this market. We bought a 35 strike put, 10 points out of the money. I said, why would I buy about 20% out of the money? And said, gee, it's got to drop more than 10 points to hit my break even at expiration, because we're not going to hold it to the third Friday of May expiration. When it starts popping down here from about 45 to 42, we got our first target at a double. Okay. Now notice we gave it a chance to get to our next target. It did work a little bit lower, down just a hair under 40, but didn't quite get to our 200% profit. And we typically say, look, raise our stop on the rest to break even once we're up past 100%. This one started coming back up to about 43.5, almost 44, and we're only making 16% on the second half. You say, oh, you let your profit slip away. But you know what? By booking half at a double, the other half at 16 and change, add those two pieces up, divide by 2, and now you're talking about a 58% and change total profit on the position over 8 trading days. So I know people will say, oh, you were at a double, you could have made more. But that's what I love, selling that part of it, in this case, half out of the double. Because if it keeps going, that's great. I've already taken my risk off. If it does reverse on me like this one did, then I say, you know what? Okay, I still made 58% on the whole trade for my Grand Slam options folks. So we're happy with 58% in 8 days. And sure, we could have been happier, but we could have been unhappier if you get passive and don't take any of it off. Then you're going to be kicking yourself when it reverses on you, if it reverses on you. So it kind of takes that all-in mentality, that poker player, I'm going to bet it all on black or red or this hand or this trade, and say, let's spread out that philosophy to say, let's take money gradually as the market makes it available to us. With that Norwegian cruise lines, we showed you 100 and 200% targets before it came down to its trailing stop at a 98% gain on the last piece. That seems like an exception, but you know what? We've been doing this fairly regularly, even in this bear market. Here's a bullish example. When the market was going down overall, US Steel, ticker symbol X, we were catching an unusual move to the upside back in late February to early March. Remember, Putin invaded Ukraine right here off of this move. That was a short-term low for stocks. We got a little relief rally, and in this relief rally, what really went crazy were the commodities, because of course the damage done not just to steel prices, but also to, as you know, wheat and fertilizer and all kinds of those commodity raw materials were where the market was saying those were going to get the sort of biggest impact of price increases that were going to happen. We all know inflation's out there. The market was telling you about that a while ago, and it's been telling you about that for quite a long time, actually. So you can see here that where's my trigger point? Percent R is going overbought, CCI is going overbought actually off of this bar right here. We close above that high, the next bar. So the next morning, actually, we're in there saying we want to buy US Steel. 29 strike calls when the stock is trading around 27 and a half. We're paying $100 a contract. $1 is our maximum. We'll never pay more than that. So the beauty of this is that if you follow my 3 different profit targets, double on half, then so another half at 200%, the final bit at 300%, you could get started with as little as 4 contracts. Sell 2, have another one out at 200, the final one out at whatever our target or trailing stop is. That would only, as little as 4 contracts, get you started. So for as little as $400 per trade, you could get started trading this method and potentially turning that $400 into over like over $1,000 of profit off of one of these trades that hits all 3 of its targets. 100, 200, 300%. This one hit 100, then 200, then it just got whipped out at a 125% on the last piece before it reversed up the next day to 300%. So that last piece, it was a little bit volatile, but you know what? When you're taking a double on half, you can afford to handle volatility because you have no risk in that trade anymore. Even if the other half of the trade went to nothing, you still would be looking at a break-even proposition, right? So in this case, that ability to let it free roll, to let it keep running, truly gives you the opportunity to get some pretty massive returns on your investment. 100, 200, and then 125% of the last piece. 3 trading days it took. So these are something where you can really take advantage of fairly quick, what I would call accelerated moves. Even on a big name like Apple. As you know, Apple was the biggest name in the world in market cap. It's been overtaken by Saudi Aramco this year, but bottom line is it's still, talking about the second biggest stock out there pretty much. And it moves like a go-go growth stock sometimes. I mean, a lot of times it can be slow. But when Apple gets trending, it's like, boy, the institutional fervor for this can be dramatic and be very fast. So look at what's happening. There's a percent R setup. CCI is setting up right behind at that next bar. And I haven't talked about this other indicator here. This is the ADX, the average directional movement. Now, these are things that are available on most chart platforms. I've tested hundreds, if not thousands, of different indicator combinations and indicators themselves. And really what we find is that these come back to be the top best, cream rising to the top, best of the best. So ADX just starting to trend up. We'll get into what these positive and directional movement lines look like, but this is basically why I overlaid the positive in blue, the negative in red. It says the bulls are in charge. We're basically getting a widening set of results. We're getting more new highs and no new lows. That's what ADX is picking up, is that, you know what that's called, right? That's an uptrend. So as these things are launching, we're saying, look, the red line on the very top panel is what I call my big trends bands. It gives me another way to visualize this. You can see before we were like, should we buy when it breaks out of the big trends bands? No, because it's not confirming. It's also not getting a CCI confirmation. ADX is also a big 0. It's flat. Then nothing's really happening. It's not really trending yet. It's kind of trying but failing. So we pass on that, and that avoided a bad trade where you got stuck in a sideways to lower market that would have cost you money as a call buyer. But we catch it in those few trading days. We got 100. Look at where we bought this, by the way. We only paid $60 per contract to control 100 shares of stock. when Apple is trading above 150. You know, if you bought 100 shares of Apple, it would have cost you over 15 grand. We're controlling 15 grand of stock for $60. Can you see the leverage potential that option gives you? As that 60 bucks went to 120 bucks, went to 180 bucks, and then the last piece cashed in around 150 bucks. So we made 100, 200, and then 146% on those 3 legs of the trade over 3 trading days. Now, eventually Apple went higher, but you see, not without a little flush out where we were able to miss. You know, if you get flushed in between, then you can see a lot of your profit get taken away, especially on an out of the money. This was a 165 call. You can see we were out of the trade by 160. We weren't even to the strike price yet, and we'd already gotten a double and a triple, and very happy to make about 150% on the whole trade. You know, how about another example? This is Advanced Micro Devices. It's become a chip leader, and AMD is one that we'd love to trade. It's maybe not as talked about as Apple, but you see, AMD was just getting that 80x upturn. CCI and % R were also getting their setups here, and then we were closing. Even though that next bar, we've got the circle there, looks like kind of a candle that's lost momentum, right? The red signifies that we've closed below where we opened. That a lot of candle followers would say, oh, you better wait on that. That's like a lost momentum. Let's see what it shakes out. And we're saying, no, you want to be in that trade. And you can see, what are we buying? When AMD is trading below 115, we're buying a 135 call, more than 20 points out of the money. We're paying 72 bucks a contract, again, to control over $11,000 per 100 shares. Big, more than 100 to 1 leverage on that. And you can see that quick move up over the first 4 days, it goes to about 120. That's not a huge move, maybe even 119. Not a huge move where the stock has moved up maybe 7 or 8% max, but we're getting 101% on the first half of the trade within 4 days. If memory serves, the second half of the trade didn't do much. We were out closer to break even on the second half. Maybe we made 50% of the whole position. I don't care about that. Even if everything looked good to go, you should always take half your position out at a double. And I really follow that philosophy, whether I trade stocks, options, crypto, whatever you like to trade. Sell half at a double is a great philosophy to free yourself up to say, whatever happens after that, give it a chance to go. If it doesn't go, stop it out at a break even or better. And then you've gotten a chance to get the triple or the quadruple, but you've been smart about taking your risk capital off at a double. Now, sometimes we take a trade off and we lose, and maybe even regret it later, and maybe we should have held it. But you know what? Risk management is really job one when it comes to being in the trading game. For me, 32 years. You've got to be able to hang around for the long haul by saying it's not doing what it should be doing. This is Marvell Tech, MRVL is the symbol. When the stock's about 75 here, we're already in a continuation trade. Our hourly system is picking up. This is a daily chart, but the hourly is saying it's making another move up. Get ready for another launch. Looked like it was ready to break out, and then boom, it flips back down on us. Usually the 5-day rule would take us out, but we're saying, look, it has earnings coming up here in about another week. We're right into a retest. This retest should hold, but it didn't hold right there. Late that day, we were saying we got to get rid of this trade, and we sold it out. We bought it for 90 cents. We sold it out for like 65 cents. 8 trading days later. We held it a little bit longer than usual because the earnings are coming up. It had all that earnings volatility in it. But earnings volatility should not be a reason that you just hold and hope to get bailed out. This trade would have been bailed out because it went to 85 on the gap up off of earnings. But the point is that whether we ended up being right or not, I never want to let hope be a strategy. I always want to say, let's follow our rules. It's not holding what it should be holding. Get rid of it. Move on, take the 23 1/3% loss. Okay. So, sometimes it can be bigger than that on the losing side, but we know when you can make 100, 200, even 300% gains, you can certainly have the upside leverage way overcoming the risk. And you can see here's another AMD example. This one hit all 3 of our Grand Slam targets, 100, 200, and 300%. The clear the bases 4-bagger, if you will, on the final piece. This is a great chart because it shows you on this left side of the chart what looks like %R and CCI in blue. Both of them look like they're breaking out there, right? But remember what I require? Confirmation. It doesn't close above that high, and we turn off the signal in the second bar when they come back down underneath their overbought threshold. So overbought's not a bad thing. It can be powerfully good. Our next setup's right here. And you say, oh, it's not confirming. Do you turn it off right there? No, because it's staying overbought on both of these. So you keep it live, and then the second bar in, it confirms and closes above there. So we're buying right there. The next bar's open. Notice first day we're wrong. I'm not afraid to be wrong, but just don't be afraid for long. Notice too that at 62 bucks, the stock drops down to like maybe 59 or 58 even on that first day, closes about 59. We're off by about $3 on the stock. That doesn't feel too good to be on that first spot. But notice ADX is starting to trend. This is a sign that the trend is just starting to get going to the upside. One bar does not make a trend. One candle does not make a trend. We know that we have to focus on, okay, give it a chance. You can see also from classic technical analysis that it's holding above the last breakout lows there around 56 or so. Breakout highs, I should say. Now old highs become support. But the point is that we don't put a actual price stop on these cheap options in the first 5 days that we hold them. We use the time stop rule to say after 5 days, if it's not working, get rid of it. So why do we do that? Because I've seen trades where if you bought it at $1, it could be at 50 cents or less in a day or 2 or 3 on a volatile stock, and then come back and go on to $2, $3, $4. I've seen it happen repeatedly enough times to know that you don't want to whipsaw yourself out of a good trade just for a little bit of market noise. So what does that mean? It means you've got to have risk capital to trade with where you're not going to panic. If this one was probably down 30% on us on the first day, you're not going to panic and go, oh, it hit a 25% loss, I'm out. That's not the way to trade this more aggressive growth kind of a mentality. What I always tell people who, if they say, look, I can't handle trading $1,000 per trade with that kind of approach. It's just too much for me to feel like if I could lose $500 on a trade. I go, well, then cut your risk in half, trade $500, trade $400, get yourself comfortable with the method and just start to build that it's a process. And then you can scale it up as you get comfortable with the method. With the great special I've got for you, you can lock in an extra bonus amount of time. So you can say, look, learn it first, trade small, and then you can grow into larger size trades over time. But you know what we see is that a lot of our subscribers, after they've been in it for a while, do like to scale up and see that one trade can make them potentially thousands of bucks in profit. So you say, what happens when you start stacking up multiple trades over time? Winners and losers, add them all together and say, okay, looking back through the end of May, we'll update this slide at the end of June as well, but from the end of May going back to the prior August. So we were just saying, okay, look back and say, okay, we're about a 9-month look back. Actually, yeah, exactly. 9 months, the last 4 months of last year and the first 5 of this year. And people say, oh, the market's been tough this year. Show me what you've done lately. Well, this is what we've done lately. You see that over 9 months, we generated $6,417 of gross profit, assuming that you don't put in more than $1,000 a trade, and that this is before commissions. Know that commissions have come down dramatically from what they used to be. When I got started trading in 1990, I can remember paying up to a $30 to $50 ticket charge, even if I was trading one option contract. That's absurd, right? Now there's no ticket charge. You shouldn't be paying more than $1 a contract on the way in and $1 on the way out. And a lot of people I know are paying as little as 50 cents. I talked to a lot of people paying an average of probably 65 cents a contract. So if you buy a 10 lot, that's $6.50 in and $6.50 out. So you say, okay, look, I can handle that if I'm making potentially thousands to have theoretically, $13 of commissions on a trade. But the point is that of course that's just one of the reasons why it's such a great time to be an options trader. Never a better time in my 32 years of options trading than now to keep the vast majority of what you earn. You can see that averages out to over $700 of profit, gross profit per month before commissions. And of course, on a $10,000 model portfolio, you can see that even though we won't carry more than 5 trades open at once, typically you say, okay, look, that's like a 64% return, even only using about half of the portfolio at max. A lot of times we might have maybe 2 or up to 3 positions open, but we can't have up to 5 open at a time. So that way, even a $5,000 account could get started. Of course, that would lead to more like over a doubling of your profit if you're putting in $1,000 a trade on a $5,000 account and up more than $6,000 in the last 9 months. Past performance is never a guarantee of future results. Could be worse, could be better in the coming months. But the idea is that you've got me and my team watching and calling out trades in real time via real-time email and real-time text alert to your smartphone as a Grand Slam Options subscriber. Of course, as you grow in confidence and your portfolio grows, you can grow the size that you're willing to trade. So over the course of years, as we've compounded it even more, you can see that 10,000 turn to 50,000 or even 100,000. You say, okay, $100,000 account, of course, in that prior 9 months made 64 grand gross profit before commissions, before subscription costs, which is minimal. Basically you're going to look back and go, wow, if I took advantage of the special I'm going to show you, you could get massive leverage on the return on your investment that you make in Grand Slam options. So we'll get into that here in just a little bit, but let me talk a little more about the filters, the indicators that make up the three legs of the stool that call out these trades. 2 out of 3 is not good enough. It ain't bad, but it's not good enough. That you've got to get all 3 of these signaling together to get a Grand Slam option signal that will call out for you. And then more importantly, we'll always tell you when to get out. We never leave you hanging. So Donald Lambert developed the Commodity Channel Index, or CCI, at the beginning of the 1980s to spot futures and commodities trends. But I've shown it to work on a lot of big name growth stocks, up and down. The reason that CCI is such a valuable addition for us is that it doesn't just look at closes. Most of your moving averages, even a percent R, puts a lot more weight on where we close compared to the high-low range. CCI factors in the high, low, and close divided by 3 to get what Lambert called a typical price per day. Of course, if you're closing near the highs, you're going to have an upside bias, or closing near the lows, you're going to have a downside bias over a number of bars. You average that out over a given number of bars, and you get a CCI Commodity Channel Index reading. Now, here's the thing, of all the things, if I can tell you to take one thing home off of what I teach you here today, it's that overbought is not a bad thing. In fact, it can be the exact opposite. Overbuy going more overbought. What did I say before? The institutions are starting to load in. It's almost like they don't care as much about the price right now. They care more about building their position and continuing to buy into that up move and knowing that that is going still higher, and they want to be a part of it. They want to continue to build their position. Likewise, oversold is not a good thing necessarily. If institutions are dumping and want out, they'll be continuing to dump that stock. You've seen it with the market this year, that overall they've continued to dump out of the equity markets as an average. Looking at the indexes, even though we're getting bounces, the broader trend has been down because institutions have been wanting to reduce risk, cut back leverage, move away from the growth and into the dividend payers and the safer sectors through a Fed tightening cycle. Does that mean you shouldn't be investing in this right now? Absolutely not. If anything, it means you should be really taking advantage of downside opportunities like I showed you, as well as upside opportunities over quick hitting 2 to 5 day windows usually. So, we're not going to hang around too long. We're going to find you the sweet spot and really look to capitalize on that and guide you through that every step of the way. How about another example on a big name stock that a lot of people would think would be too slow for even 100% profits, and it made us more than that? This is Microsoft, Mr. Softy, MSFT. Look at where we were getting that breakout on Microsoft. Things were getting confirmed. This is a daily chart. We're getting them confirmed on the hourly chart. The stock's in the neighborhood of about 225. This is going back here into last year, but the point is still the same, that, we're looking about 10% out of the money on Microsoft. About the January expiration, looking at the February expiration, about a month out, we're going 10% out of the money. And we're paying less than $100 a contract, $88 to control 100 shares of Microsoft. That would have cost you $22,500 if you bought the 100 shares outright. You can see the leverage factor on this is into the 250 to 1 plus mark, right? So as it makes its first quick move, just up a couple of percent from 225 to 230, we're booking that first half out at 104%. We get our risk capital out and a little extra, and now we're trying to ride for the next target. 200% plus 206 is achieved on the day 4 here. And day 5, we just missed our 300% profit as it came down that day on that red candle. You can see we're out at 122% on the last quarter of our position. So sell half, then another quarter, then the final quarter is how it works out in terms of pieces of your original position. As you can see, Microsoft kept kind of edging higher, but you can see it didn't have to go to 250 to get our target. In fact, the highest it ever got here was about 240-ish. And so that's the point that you should also take home, is that as long as you're not hanging around too long, you don't have to get to the strike price to cash in on out of the money options. You can, if you catch the speed of movement kind of acceleration accumulation phase on the way up, or the harsh distribution phase on the quick waterfall moves down, that's where you really get paid with out of the money options going closer to the strike price and getting the double, triple, quadruple potentials potentially realized. Now, when you look at what makes these signals so powerful, let me just kind of spell it out a little bit more in words as well as pictures. ADX, as we talked about, this is an indicator developed by Welch Wilder, the same trading genius who developed the RSI, the Relative Strength Index oscillator, and so many other great indicators decades ago. ADX, the way we use it is, as you've seen, is that we want to pick up that we're getting more new highs, which is the DMI plus going up, and less new lows, the DMI minus going down. That's the classic up channel that defines an uptrend, right? Up, up, and away. Okay, so bottom line here is that what you're seeing is that the directional movement lines are kind of spreading apart. We're getting more new highs, less new lows. That's why those DMI lines kind of spread apart. The difference for us is that ADX should be coming from a relatively low level and starting to cross up above that declining directional movement to say that it's the start of a trend. Some people I know wait for ADX to go above 30 or even 40. And to me, in our testing, that's way too late. You're leaving too much money on the table here. So this next chart's a classic example of an early ADX upturn that caught a very quick acceleration. This was in AstraZeneca, AZN. AstraZeneca, of course, was one of those back in the post COVID coming out in 2020. Everybody's looking for a cure, right? All the big drug manufacturers are out there looking for trials that'll tell if they're on the right track. AZN was in that mix. Of course, it wasn't a one product company. They already had billion-dollar drugs that were out there, but you could see that we were getting not only the CCI and %R breakouts, but we're getting the ADX cross up off this low level, just starting to turn up. So we were in there when the stock's in the neighborhood of about 58, saying buy the 65 strike calls out about 4 to 5 weeks from expiration out on the third Friday of August. There in mid-July, we were paying $83 a contract. In 2.5 sessions, we were up 100 and then 201%. And actually in 2 sessions. And that was a Wednesday and then into Friday, we were cashing those first 2 legs out. And I had subscribers saying, why don't we just take the rest out? They're coming out with their COVID study that next Monday morning. They're saying, no, you've got a free trade, give it a chance. That last quarter, when it gapped up that Monday morning, we cashed out at 357% on the final piece. So those are like the extra kickers, if you will. You've already gotten a profit on the trade guaranteed when you get your first 2 targets, but you're giving yourself a chance to get that bigger, final grand slam 4-bagger plus in this case. And that's what I want to remind people of, is that, a lot of people are happy with 20 and 30% gains. And I'm saying that's not going to cut it with this strategy, because when we're wrong, you could lose 20, 30, even more on some individual trades. So you need the doublers, triplers, quadruplers to more than offset the occasional stop losses after the 5 trading days that we'll call out. So the point is, look, don't cut your profits short. Most people let their losers run too long. That's what our 5-day time stop will help you with. And then we'll guide you with when to get out and book those bigger multiples of your investment opportunities when the market makes them available to us. Now, one of my all-time favorite indicators is actually a derivation of Larry Williams' %R indicators, what I call big trends bands. And this is back to that concept of saying, do you want to trade a range or do you want to trade a trend? Larry Williams developed percent range to kind of show where that vehicle is trading within its proven recent look back range. But you can see if we're hitting the top of that range and then we're going through that big trends band in light blue, it's outside of that big trends band. This thing is going vertical to the upside. Now, people will tell me when they see this chart, oh, you took 100, 200, 300% gains in 4 days. You left money on the table. It went up a couple more days before it flattened out. Why not use a trailing stop? Because a trailing stop will basically whipsaw you out of too many good trades, or you'll walk in the next day and have a big gap against you, and then you get no chance to control your profit taking. You're just kind of panicking out on a big gap move against. We like to take money out gradually as the market makes it available to us. But if you're not happy with 100, 200, 300% in 4 days, 4 trading days, you're going, okay, you're probably in the wrong service. I have a lot of happy subscribers in that type of an instance. And Grand Slam Options has been probably our best program over the past 3 to 5 years, looking at our big trends set of services. it is a more growth and you've got to be willing to take some more risk. But the beauty is you can cut your dollars back so you don't have to trade as much getting started. As little as $400 a trade you could get started with. In fact, you could get started with $100, but that would just give you the first target of the doubler. I'd rather see you have the chance to make the even bigger multiples of 200 and 300% or 3 and 4 times your original investment. That's where options really pay off. So the beauty is overbought, staying overbought. That's what this percent R chart shows. I've left it color coded in red. Was red bad there? No, red was powerfully good. We have rules to say, book them Dan-O when we hit our 300% on the final piece, we're done and moving on. It's kind of like the 80-20 rule. Stay in the top 20% of those percent R readings leads to kind of the top tier, best of your best trades typically. Likewise, really oversold markets can be really bearish. Now, anybody can put the indicators in the chart, but the beauty is you got to be able to see where the big opportunity, the big trend is. That's where these proprietary setups are so powerful. So, the beauty of this is that when we stack these indicators together, we know there's going to be losing trades. We know that you want to set yourself up in the position to say, okay, as long as I can focus on the best of the best opportunities here, I'm going to say, look, this is like what a lot of people call outliers. Like Malcolm Gladwell, one of my favorite authors, not a trading author, just general authors. He wrote The Tipping Point, but he also wrote a book called Outliers. And it's that same principle of finding the unusual moves is where you're going to get yourself the best of the best opportunities. So let's just look at that snapshot again and say, okay, look, when you focus here on, over the last 9 months, we generated over $6,400 in gross profit. That means adding up all our winners and losers, not counting commissions. Sure, take a little bit off for commissions, but you can see on a gross profit of over $700 per month on a $10,000 model portfolio, putting no more than $1,000 into each trade. Even when we're growing it dramatically, we didn't raise that $1,000 number. If we wanted to compound these numbers, compound the trade investment, we could show it even much bigger. But we're taking a pretty conservative approach at big trends, relatively speaking, compared to a lot of others. So I've been in business for 22 and a half years and going strong. But the beauty of this is that, 64% in 9 months, obviously that compounds really well year over year, be more than 80% annualized, right? Pushing towards 85. But bottom line is that we don't take the most aggressive options approach. We use monthly options, not weeklies. Why don't we use weeklies? We could get even more bang for our buck, because that added time value that we might not need a month. If we buy a month out, we might only hold it for a week of that month. We hold it for a week, got 3 weeks left of time. That gives us more stability, believe it or not, when we're talking about these fairly aggressive options. So when you look at the time decay curve, most people would look at this chart and say, okay, if 0 is the expiration day, okay, so the options go bye-bye at expiration, right? If they're at or out of the money. This assumes you're looking at an at the money or out of the money top option where it's all decay risk. Well, a lot of people say, well, don't trade them less than 30 days because you can see that's where a lot of your time risk is. But what's the problem with trading them, say, 120 days out, where you say, hey, if I held it for 30 days, that's a tiny sliver of time I've lost. The problem with holding them 120, even 90 days, buying them 90 days out, is that you're guaranteeing yourself an earnings report in there on a quarterly earnings cycle. And that means you're going to be paying up for the earnings volatility. And that means you're going to hurt your leverage potential. For me, usually somewhere in about the 30-day window, but it could be as much as about 40 days or as little as about maybe, 21 days, somewhere in here. That's about as little as low as I'll trade. And you can say, well, if I hold it for a week, I'm going to lose that sliver of time, whatever that week of time is, right? So I'm losing that little bit of decay, a little bit more as we get down in here into about 3 to 4 weeks out. But if I'm 14 days out, I will not buy an option with 2 weeks or less till expiration. I won't hold it with 2 weeks or less till expiration. So at the 14-day mark, I just say, get rid of it, win, lose, or draw. So we recently cashed in on a BP call that had about 2 weeks ago till expiration. It was up like 57%. We just said, take the money, move on. It's too risky to hold its expiration. If we'd held it, it would have wiped out because the oils got killed here this past week, as you know. So that's where the 14-day rule, don't hold options in the last 2 weeks of their life. But if we hold it for 5 days, with about a month ago, we can have a manageable time sliver, and our leverage potential is a lot greater because we're not paying for earnings volatility. We're paying for directional trend to overcome the time lost. Another AZN trade that I did, so I've got a focus list where when you sign up, I give you all the rule sheets, all the setups, all that information, all the parameters on how many bars back to add for each of the different indicators. You get all that as a subscriber. But here's another one where we doubled the first half. This is AstraZeneca. We bought, when the stock's about 55.5, we bought a 2 out of the money, 57.5. It ran up over those first few days to the strike price. Our 69 cents was turned into $1.40. We took 102% out on the first half. And then it rolled over and actually lost 1.5% on the second half when we sold it out here, as it rolled over after 7 trading days. And that was just too much of a give back. Even though it's up from where we got in, we've lost some time premium, right? So we've gone back to around the break even level. You say, how can you let all that slip away? Well, because we're trying to give it a chance for the bigger run. Everything was still pretty much all systems go the day before, but then it changed that next day. And we're saying, okay, look, got to say bye-bye, sell the second half out, down 1.5%, add those two halves up, you're at 101.5 divided by 2, you're like 50.75%, just under 51% gain for the whole position. So you're saying, okay, I make 50% for the whole trade, even though the second half didn't fire. That's what selling half at a double does for you. It still makes you 50% in 7 days when you sell the second half out at a break even-ish. So you can see how that works. And of course, it just chopped around and would have been just a time decay death spiral if you just sit there, hold and hope. You don't want to do that. So that's where we guide you through and help you really manage how these trades work. So we all know that not every trade is going to be a winner. Okay. I don't even need a massive high win rate with this strategy, because when you buy out of money options, a flat option is going to cost you money, right? So we need to wait and find those fast movers. That's why we guide you through, whether it's an hourly chart, whether it's a daily chart, we guide you through when to get in, when to get out, with real-time email updates, real-time text alerts to your smartphone. Say, get in here, raise your stop, take your profit. Here's your new target profit on the next piece. Here's your final target profit. Get out, be done, or it hasn't fired, be done with it here, get out at whatever the option price is or better. So we'll guide you through that with really specific call outs. If you wonder what that looks like, actually, let me just for a second pull up what a typical trade alert cycle looks like here. So if you look at, remember I talked about that range resources. Now, this is not a new trade recommendation. We're out of this, okay? But just as an example, when you look at a name like range resources, you say, okay, when we called that out, we got into RRC back in late May. It was like May 25th. Okay, so when we got into it, this is what our first target looked like. So we said, okay, we're into this. We bought it to open. Now we say sell half of that June monthly 34 strike call at $1.70. Remember, we bought it for 85 cents. So once we get that target profit, then we come back and we say, okay, we got that target profit. Then we say, okay, now, okay, we're going to raise our stop. Remember, we bought it for 85 cents. We're going to put a new stop in at 90 cents. And now that we've gotten our first target achieved on a double and half, you're going to sell another half if it gets to a triple, 2.55. That's basically 85 cents times 3. And our final target was hit at 3.40 after that one. So you can see this is coming right off of the open, 9:32 a.m. Eastern. A couple minutes after the market opens, we're adjusting and saying, hey, we just got our target profit. Let's take our next target, put it out there so you know how to manage the position. We send that through real-time email and text to your smartphone, so you can make sure you don't miss an alert, miss an opportunity getting in, and more importantly, where to get out. So we're guiding you through each and every one of these trades. You're never an island unto yourself. We're basically guiding you through, walking you through what to do with every single trade we recommend, whether it's a winner, whether it's a loser, whether it's a draw. We're going to guide you through everything, never leave you hanging. So just as a reminder, if you came in late just on the recent performance, like we said, if you're putting in $1,000 a trade, you can see that over that 9 full months look back through the end of this past month, $6,400 not including commissions. So take it down a notch for commissions. You're still way ahead of the curve on a model $10,000 portfolio, putting $1,000 in a trade. You could literally do this, since we don't hold more than 5 trades open at once. You could literally do this with half of that, with 5,000. Technically as little as 4,000 if you want to get to the 10% per trade, $400 level. It's probably about the lowest I would recommend going. But you can see it's something that doesn't require a lot of capital to get some really dramatic growth potential, regardless of the market direction. Because let's face it, you've heard the phrase, kind of whatever the markets are doing, there's still a bull market and a bear market happening somewhere all the time. And so our job is to guide you through which of these individual stocks is going to be on that next big wave. Sure, we watch sectors, but it's the individual stocks that really give you the massive bang for your buck. And as you grow your portfolio, of course, you can move from a $10,000 account going up to a $50,000 or even $100,000 account. Of course, on $100,000, you might be putting, say in this example, up to $10,000 a trade, which sounds like a lot, but of course, that's still just 10% of your account at that 100,000 level. And in 9 months, you'd be up 64%, again, 64 grand on a $100,000 account. Looking backwards, we know that past performance will not guarantee future results. That next 9 months or next any period can be more or less than what's happened in the past. So you know that we have to, of course, be careful to say no matter how well it's done, the biggest mistake that you can make with a winning system like this is overcommitting your capital. Saying, okay, this thing's hot, I'm going to go load up on the very next trade. I'm going to put half my account in or 25% of my account in or whatever. That's a mistake. Even if that wins on that trade, you're setting yourself up for a big problem at some point going forward. So you want to smooth it out by saying don't overcommit your capital on any one trade. We always encourage new subscribers to start small and build. So let me tell you how you can get started with this Grand Slam options strategy. And I'm going to basically, because I've known David a long time, and David and Anka have been very good to me. I'm going to actually give you kind of an extension of something I actually recently closed out for my Big Trends community. And it's basically saying, okay, look at this offer here. If you were going to get my Grand Slam service on a month-to-month basis, it'd be $297 a month. And what I'm going to do is I'm not just going to give you a year of access. I'm going to actually make it a buy a year. I'm going to throw in a second year on me. So I'm going to give you a 24-month access to the next 2 years worth of trade alerts. That would be on a month-to-month purchase more than $7,000 costs with then my weekly video updates, which that's a year's price. It would actually be like $1,000 value on 2 years worth, but I'm gonna give you 2 years of access to my weekly video updates. That's $7,600 plus. And I'm going to give you bonus access to my Grand Slam options rule sheet, which gives you all the parameters on what to plug in for percent R, ADX, CCI, etc. I'm going to give you all this and get you the ability to access for 4 easy payments of just $297 over today, and then $297 in 30 days, etc. When you go to the special link that I've set up for you here, members, it's not www note, it's members.bigtrends.com/slam. So when you go to that page, actually, I'm going to make it even better for you, because that would cost you almost, as you can see here, almost $1,200. I'm going to give you one better. Instead of costing you $1,200, I'm going to say, you know what? You can get started today for a one-time investment, not for the next year, but for the next 2 years access for just $997. So I'm saving you, instead of paying $1,188, which is what I had up there, I'm going to take it down one more notch, get you under $1,000 for 2 years access, plus the rule sheets, plus the weekly video training, all in 2 years access to Grand Slam options. You know, literally, 100 to up to 150, maybe even a couple hundred trades, but we care about quality first more than quantity. So even if it was 100 trades, that'd be less than $10 per trade over the next 2 years. It could be even more than that. But bottom line is that it's about the chance to make those, as I showed you, $10,000 account has made $6,400 in 9 months. For 2 years access, you're getting it for just under $1,000, $997. So we set it up to make it really easy for you and give you the chance to make many multiples on your investment. You can see here that there's several ways you can pay. One, you can enter your credit card number up here on the top. We take all the major credit cards. You can also go click the PayPal button down below. And the beauty of this is you just get your billing information in here, and lock it down. And you can see if you've got questions, we give you both at the top of the page, our 800 Big Trends number, and the email address, clientcare@bigtrends.com. It's also there at the bottom of the page. We do ask you, review the terms and conditions here on this linkable terms at the bottom. And then once you've done that, you've got to hit the I agree to the terms, which are linked again here. So we've been in business, like I said, on our 23rd year now. I launched the company in November of '99. So we serve tens of thousands of traders through all kinds of bull and bear market environments. So I have a lot of confidence in my 32 years of experience. I'm going to guide you through exactly how to do it. Like I said, I'm saying forget the 1188 total cost. It's going to get one easy payment of just $997, locks you in for not 1 but 2 years access for just under $1,000, $997. Okay, so that's a fantastic value. It's something that's not going to be out there very long. Make sure you type in members.bigtrends.com, not www, so you can become a Grand Slam Options member and start taking advantage of our very next trade, which could be out as early as tomorrow morning. If you've got questions too, we've always got live bodies here during business hours, 8:30 to 5:30 Wall Street time, to guide you as a long-term Big Trend subscriber with this 2-year special. So I'm out of time. I want to thank David and Anka for having me. It's always a pleasure to share with you what's been working for me in today's markets and what I think can work for you going forward, not just in 2022, but this will cover you out to June of 2024. We're there to give you massive value on your trading investment with Big Trends Grand Slam special. So thank you, David, so much, and I look forward to seeing you hopefully soon.